I think that's a fascinating question to ask yourself. And I remember early on, I made a commitment. I was like, I'm going to spend the next 7 years to 7 to 10 years of my life solving this problem for financial advisors and back office users. And I was like, I made that commitment. I remember saying it out loud. And it ended up working, exactly about that timeline. So
And what do you think is the biggest misconception about building a startup? Is it that like they just don't understand the time horizon?
I think that's one part of it. The second piece is like the company building stuff is actually quite easy. Like the fundraising, the product building, the go to market, right? Like they're intellectual problems that anyone can solve. The hard stuff is going to come for you personally. And what I mean by that is a large part see building a company is it's going to hold up a mirror to your biggest growth challenges as an individual and like where your blockers are personally, where your triggers are.
Hey everyone, welcome back to the Ignite podcast. Today, we're thrilled to have Louis Retief, the co-founder and former CEO of Hubbly Rhymes with Bubbly, a pioneering wealth tech company that revolutionized wealth management for hundreds of firms. Louis led Hubbly through its journey from startup to strategic acquisition by Docupace. He made a significant impact there in financial advisory workflows. Very cool. We could talk a lot about that. I worked in finance way back in the day. He has a background in finance, automation, productivity, passion about creating a community of super builders. Very interesting. Welcome to the program.
Thank you, Brian, for having me. Excited to be here.
Would love to, kind of start at the beginning. Like, how'd you end up founding and scaling this company called Hubbly?
It was a weird journey getting here. It actually started off as a peer-to-peer lending company, if you would believe that. I actually got denied a student line of credit when I was in college, and because I had a parking violation, and I was like, this is ridiculous. I'm a trustworthy individual. I've like paid back, a bunch of loans I took from my parents to start companies when I was in high school and whatnot. And I was like, you should be able to register your informal loans and report them to the credit bureau and to build credit score that way. And so that's kind of where the idea started. It was a long path getting to a workflow and automation efficiency software for financial advisors, but that's where it started. We large part stumbled upon the problem that we solved at Hubbly. We actually went door to door knocking and we interviewed about 150 families and households, asking them about their personal financial struggles, trying to get the market validation for a peer to peer lending application. Long story short, nobody wanted a peer to peer lending application, but everyone was like, I could really use some financial advice. And they were looking for quality, financial advice that they were just not able to find. And then we're like, okay, well, what's wrong with the financial advisory market that people aren't getting access to the services that they need? And we turned around and cold called and interviewed about 150 financial advisors. And it became really obvious that they had a problem with efficiency and automation. And, it was clear that there was a workflow problem. And we started building Hubbly with that in mind.
It's fascinating. So it's classic founder story. Like you set off to solve one problem. You start talking to the people that you think have the problem. They're like, actually, no, I have this other problem. And then you kind of go to the financial advisor, like, hey, why aren't you solving this problem? And they're like, well, I'm limited in time. I don't have time to service everybody. So I got to focus on the top, 5 or 10% with my limited bandwidth.
It was purely a capacity issue, and it's still large part the same problem we solve today. I think interestingly enough, if you look at some data and numbers on this, I find it fascinating. So there's about 38 million households in America that have about over a $500,000 net worth, which is around the stage where you probably should have a financial advisor working with you.
At least somebody looking at your retirement planning, your estate, your insurance, all those things. Yeah.
And there's about 300,000 financial advisors. So you simply take just, 38 million divided by 300,000. That's about 116 households per financial advisor. Now, it's well known in the industry, like serving more than 100 households as an advisor is actually near impossible. Like it's a very difficult thing to do. It's hard for the average human to have more than 100 like ongoing relationships, right? And so,
hey, we have 200 startups, and I don't remember half of them. No, I'm sorry, I'm just joking. But
I'm not surprised. And so there's this clear capacity problem because it's a pretty comprehensive and complicated service to provide. And so there's an immediate capacity problem that you run into. And then I think it's interesting to think about, the service expectation from a financial advisor that you have, right? Like You want them to look at your insurance, your investments. You want them to look at your end of life planning, estate planning for that matter of fact, your tax planning. It's a pretty comprehensive service. And I find it interesting comparing that to if you think about the average financial advisor at a bank, right? All they really do is sell you products. One financial advisor at a bank normally serves about 800 to 1,000 households. And so it's interesting to think about like that idea of capacity of a financial advisor and how many people they can actually service as like a problem that we're trying to solve. Because if we can increase through efficiency on automation, more people would get access to these services that they in large part need.
Interesting. So what is it about being at a bank where they can service, almost an order of magnitude more?
They're specifically only focused on those products at that bank, right? Like
they have the infrastructure around them.
Infrastructure around them. The scope of service is a lot smaller, but they also have a lot of, you have a customer support center you can call. Like I literally today, funny enough, I have like an account manager just at my own bank. And today I got a call from their financial planning division, right? Saying, hey, do you need some help with financial planning? And so I think there's just a lot more infrastructure and capacity building from a back office standpoint that has been done to support an advisor to serve that many accounts. When you're operating large part an independent financial advisory business, you don't have those back office services set up to support your clients to that level of degree. Or
did you always know you wanted to be an entrepreneur? Like I hear this a lot from founders. I'll be like, why are you doing this? It's like in my form. I'll be like, I always wanted to be an entrepreneur. And I'm like, okay, why and how did you know? And what made you start a company? That's kind of an act of insanity in a way.
It's without a doubt an act of insanity. And I still think I'm a little insane today. It was funny when I was growing up, my dad always said, so I come from a long line of doctors. My grandpa's a doctor, my dad's a doctor, my older brother's a doctor. They actually all have the same name as well, which is hilarious. How did I end up in the entrepreneurial world, let alone WealthTech? My dad always said growing up, he's like, Louis, I have no idea what you're going to do one day, but you're likely going to make something more efficient. It's funny that I ended up building a workflow company, but early on, like I started my first business in high school. I started a company called Plugged In, and we did social media management for local businesses on Facebook when it was all the rage back then. We actually helped the company OMG Candies launch on Dragon's Den which is Canada's Shark Tank. And then I started my second business in first year university. I ran one of those.
I didn't realize you were from Canada until you said Canada.
Yes.
You kind of had that Canadian inflection of Canada.
I'm actually not originally from Canada, funny enough, Brian. I was born in South Africa. My family immigrated to Canada when I was 11.
Okay, so you kind of have a little bit of the influence. Where'd you grow up in Canada?
Vancouver.
Oh, okay, wow. I'm from Seattle. My family's from Vancouver, so yeah. I mean, we're all ultimately from Europe somewhere, but yeah, at least in the last couple generations. Yeah.
And I started my second business in first university. I ran one of those college painting businesses. That was a great company to run. You made so much money painting houses. It was actually insane. I would highly recommend.
That's a lot of work. Nobody wants to do it.
It is
and you could charge thousands, if not tens of thousands of dollars to paint a house.
Yeah. And I was getting paid like, in first year college, like $55 an hour just painting houses. I'm like, this is amazing. And so I always wanted to build something. I actually started Hubly in my last year of university. I did not fit well into a employment structure where I had a boss, and I liked the level of responsibility, the autonomy that came with it. And generally I found that I'm able to challenge myself quite a bit faster than anyone else can. And so I always try to create environments that made sense for me. And it was pretty obvious that I was going to be an entrepreneur for many years.
I never fit into any employment environment either. Like I'd always leave after 6 months, a year. The longest I ever stayed was 3 years because I was getting my MBA part-time. And I was like, well, I'm not going to change things up while I'm getting my MBA. I'll just keep doing that. But same problem, right? And you kind of see it, I think, in working environments where you're like, this person's they get a high off the bureaucracy. There's something about bureaucracy for this person or this set of people. They just like it.
Yeah, they
just thrive in the bureaucracy.
And they like creating more bureaucracy, which is also a fascinating thing. It's not that I enjoy the existing bureaucracy, but I'd rather add to the existing and add more processes than try to remove.
Push down the autonomy, let's push down the decision making. But some people just relish in the hierarchy, the gamesmanship of the people conversations.
Yeah, I have a buddy who's just he was so good at climbing the corporate ladder. It was almost impressive. I'm like, how did you do that so quickly? And so there's almost an art or a skill to it. I haven't figured it out yet.
Politicians.
Yeah.
Yeah.
Politicians is probably the same type of career path, right?
Yeah. It's like I'm just really good. And then it's usually the death of companies when the bureaucrats and the politicians take over. That's the beginning and the end. So talk us through the journey of Hubly. Like what was the kind of the origin of the problem that you identified, and kind of walk us through the kind of the early days.
Yeah, it started off with just watching customers and learning from them. We had them screen share and we're like, how do you do this? And we focused on some of the most common things that activities that a financial advisor does and their team does, which is, they open up accounts, they onboard clients, they regulation wise, a financial advisor needs to meet with every single client once a year. So there's a recurring, meeting scheduling process. Like nothing insane in terms of a workflow. Like they were just like classic business operating workflows. And at that point in time, my co-founder and I were pretty big fans of tools like Trello, and that was kind of early days of Asana and Monday.com. We're starting to like be the calling themselves either project management systems. Now they're all call themselves like operating systems for your business. And we're like, well, we don't necessarily need to reinvent the wheel here, right? Like, can we take these existing operating systems, project management systems? They've built a very unique user experience and UI that are intuitive. Kanban boards just work for the human brain. Can we take that similar solution set, but apply it to a niche market? I would large part describe Hubly as Trello on steroids, purpose built for financial advisors. Like at its simplest state, like that is what it is. Now there's some very industry specific integrations, automations, etc. that we've had to build, but at a base level, like you could say it is that.
Love that. So how did you approach building this verticalized SaaS for financial advisors? What was the core problem? Was the core problem like, uh, uh, you know, from an investor perspective, couldn't just a financial advisor that's sufficiently motivated build out their own Trello system and configure like an Airtable or a Notion? I guess this was like before those maybe, but to get this done, or yeah.
You large part could, and you could still do that today. Our core differentiator is definitely, three things. One is because it's a heavily regulated and compliant industry, you have to be able to integrate with a CRM, and there has to be specific CRUD rules that you follow, which is your create, read, delete rules. Like if you edit the task completion, there needs to be an audit trail of when that task was edited, or when notes are added to the system, you can't just delete those notes. And so we follow some very basic protocols there, which your classic Trello or project management systems don't follow for this industry. And we also integrate directly with their leading CRMs in the market. So when certain workflows, tasks, or activities are completed in Hubly, we compliantly log those back into the CRM. Now, the concern about adopting a Trello or an Asana for these advisory firms is that I would not have that compliant record in case I ever get audited. So there's the audit-proof nature of Hubly and the integrations. The second piece is our templates library, right? If you start with a Trello or an Asana, they're going to serve you templates for classic SaaS marketing workflows or project management tools for running a product team. They're not serving you templates purpose built for, tax planning or for account opening with Charles Schwab. Like the templates library that we've accumulated and built and all the data we've collected from the hundreds of advisory firms that we work with have really helped us acquire new customers because they don't have to build these things from scratch. And then the third piece is just the more specific automations that we've built out in our system that allow for some sophisticated conditional logic and or automation rules based on our specific niche market. A large part, the three reasons why they would use us and pay. If you look at our pricing, we're about 6-8 times more expensive than a Trello or an Asana. But because of those value adds, our niche customer market is willing to pay it.
Yeah, it drives me crazy because Airtable's charging me, for AI credits now. I use AI for everything. And I could spend the time wiring up all the, the API calls to 4.0 and do it myself. But I guess I don't want to, I'm not going to spend hours and hours to save, the $20 a month to pay for their premium AI credits.
Yeah.
I could just shoot a field out, get a response, put it right back in a field so easily. I know I could, but it's just not worth my hours and hours of time to save $20 a month, or maybe in your case, $100 a month? Like how do you guys price it?
Yeah, we price per user similar to, most operating systems. And so it's a per user based price. Obviously, the more people that are in there, the more valuable the system is. And so we have 3 different pricing tiers for different segments of customers and price per user.
In hindsight, why was it the right time for your business? Like if you kind of look back at this, and a lot of being a VC is like thinking about, why is it the right time for this business? I mean, you could have probably built this, 10 or 15 years ago. There probably were incumbent operating systems that they were using from 10 to 15 years ago, or they're hacking together like a Salesforce or HubSpot or something.
Yeah, I think it's interesting. If you look at the wealth tech space more broadly from about 2018 to now, you can go back and look at some of the market maps of the space. We incorporated Hubly in early 2019. There's been close to almost a 600% growth in new wealth tech companies. At the time when we started Hubly, there's your broader fintech market, and then there's your subsectors of fintech. I think everyone always talks about fintech, but it's like, I actually don't love talking about fintech. Like, what's the sub vertical of fintech that
Yeah,
you're
it's like saying
focused on?
B2B SaaS. Like it's kind of everything. Yeah. What are you
Exactly.
talking about? Yeah.
Like, there's 15,000 fintech companies. Like, it's too broad of a category to be specific. I have a lot of entrepreneurs come to me, younger ones who are like, I'm interested in fintech. I'm like, that's useless. Like, what's the category? And so when
What
I
in
started
fintech? Yeah.
Yeah, when I started Hubly, there was a lot of, in 2018, there was a lot of boom in the, what I would call your more consumer fintech, specifically in your, robo advisors, no longer a term you see often anymore. But then there was your additional sub vertical, which is your wealth management tech space. And it was very underdeveloped from just a number of companies standpoint, if you compared it to the other market maps under the fintech. And I was like, oh, this is an underdeveloped fintech sector. And it was the same time I found it when I was doing interviews with the financial advisors. And I was like, this is just an underdeveloped market. I was like, there has to be growth here. There's no other way. There's a way forward, right? There's going to be additional money funneling in here because consumer expectations are changing, meaning that financial advisors' expectations are going to change as well. And there was just a clear opportunity in growth in the wealth tech market that was going to come, and you've large part seen that growth. I would probably be cautious about entering the wealth management tech space at this point in time. You're mainly seeing consolidation now. Like, that's large part one of the reasons Hubly got acquired, because there's just too many companies. It's to the point where the buyers are overwhelmed with options, and then that's a hard time when you're trying to enter the space. Like, in early days for Hubly, like, there was so few new technology companies. Like, financial advisors would just like hop on a call for hours to tell you about their problems because no one was asking them about their problems. And that's harder to do nowadays.
That's a really interesting. I mean, vertical SaaS does eventually fill every niche, but then there is a consolidation ultimately that happens at some point. That's really insightful.
There's a cyclical consolidation. So, like, if I was interested in the wealth tech space, I'd probably wait a year or two for the consolidation, you're going to see it over the next 2 years. I think you're going to see consolidation. Once you see the consolidation, you'll see the winners, and then there's going to be space that opens up in terms of opportunities from there. And I think that's natural for any industry.
Yeah.
You go through your boom, consolidation. And so that's one of the reasons. There's a number of other ones why we ended up moving forward with the acquisition, is just thematically, I was like, it's time for consolidation, and it's either do I ride through the wave of consolidation and then become the consolidator of like buying companies, or take this opportunity now while this is happening in the market and then build from there.
Nice. How did the acquisition go down? They approach you, and then how do you kind of navigate that whole process? There's a lot of founders that listen to the show. Like, how should they think about these like cold inbounds or warm inbounds of like, hey, like, we like your company, let's start an acquisition talk here?
Yeah, it's a great question. And it's like, I think I get an email still, or at least before we got acquired, I got an email almost every single day from someone either trying to ask us if we need money or wanting to acquire us. And it's like, how do you filter through the noise? We were approached by Docupace, but not directly by them. I actually had a standing relationship with Genstar. Genstar is the private equity firm that owns Docupace. Genstar also owns a number of other companies in the wealth tech space. and they're a very well-known PE player in the space. I actually spent some time with the managing partner there while they were trying to understand the workflow thesis in the market. I just spent some time with them because they were curious about my input, and I knew about the Genstar private equity firm, and I was like, this is a good firm to have a relationship with no matter what happens with Hubbly in
I
the
would love an
future.
intro, actually. I was just thinking, I don't know those guys, so I'd love to talk to them.
Yeah, they're great, and they know the wealth tech space really well. And I've done enough calls with investors that it's like a lot of them are just trying to either get information from you. Then there's the ones that are like actually incredibly knowledgeable as well about the space, and you have a very intellectual conversation about where the space is going. And like that was present with the Genstar team. And then about a year after that conversation, they reached out to me and they said, "Hey, we just finished letter round into Docupace. Would you be interested in meeting their leadership team and speaking to the CEO?" And I was like, yeah, like introduce me. And it happened very naturally from there. I'd say part luck, but also just, I think you need to know who the big PE players are in your market, because they're likely the ones that are not necessarily going to buy you. They're likely the ones that are going to buy the companies that are going to buy you or be in the majority ownership path of those companies. And so as a founder, I think you should know what private equity players are and what moves they're making in the space. And there's a couple of big folks in the wealth tech space that are starting and have been doing acquisitions for a year. That's how I knew the consolidation is coming, as you normally see a ramp up of PE activity.
Really, it's really insightful. I'm learning a lot here. I wish I knew more PE firms. I don't. So that's a gap in Team Ignite I'm thinking about now. I think that's really insightful. And a lot of people don't know this. So I'll ask you, like, what percentage of companies get acquired versus IPO?
Very little go IPO.
Yeah,
I
it's
don't
only
even know how
8%.
low the percentage
Yeah,
is, but it's that low,
it's
right?
8%. Only 8% of
Yeah.
companies actually IPOs. Now over 90% of companies get acquired. And I don't know what percentage of those are private equity firms, but I would imagine it's the majority. 2/3, 3/4, something like that. Somebody in the comments on this pod can comment if you know the answer. Let us know. And I think that's super insightful. Anything that you wish you knew when you started the process that you know now? Anything lessons you can distill for founders going through a similar process?
Yeah. I asked the several entrepreneurs about the process before going through it. And it's like, you just kind of got to go through it and it's going to be incredibly painful and terrible and fun all at the same time. And you're going to learn so much. I think I wish I planned a little bit more for how much work it was going to be. And I think I was genuinely surprised at the level of detail that an acquirer needs to know about your company before acquiring you. Like they want to know
The
every,
diligence process is insane for private equity. Yeah.
they're scrubbing the, bottom side of your toenail to figure out, some sort of information is like what it feels like at points of times. But it also was like, obviously they need to know all this information, right? The disclosure schedules and all of that stuff is so important. And so I just have a lot more respect for the acquisition process. And I think it also makes a lot more sense to me to think about, because of how complex the acquisition process is, rightfully so, it should be, why it's very hard for smaller deals to get done, because the economics of it just doesn't make sense, right? Like the legal fees that you pay, the finance diligence fees that you pay are at minimum going to be $500,000 to $1 million, right? Like if you just look on the low side, investment bankers don't start doing deals until they reach that stage of their own compensation. So, deals in your, lower millions just don't get done because there's not enough money on the table for anyone involved, right? And so I have a newfound respect for just thinking about the economics of a acquisition process, and how everyone needs to get paid. And so I think those are things I wish I knew a little bit more of, but I don't think I would have understood them unless someone just told them to me.
What's been the biggest challenge for you as you transition from a founder-led company to being part of this larger conglomerate?
Yeah, so Brian, it's been almost 5 weeks, so
Wow.
it's not been a long time.
Yeah, I didn't realize it was that soon. Yeah.
Yeah, it was not too long ago, and so probably the right answer is I don't know yet. I'm still learning a lot, and I think fortunately it's not like Docupace is a massive organization. They're around 100 team members, so it's still I'd say a smaller company. And what's an interesting perspective change for me that I'll maybe share, because there hasn't been anything challenging yet. Like the culture integration has been great, their support's been great. large part have gotten a lot of autonomy and freedom to continue operating and running our entity as we see fit, with just more support. I think my one of my advisors shared an interesting quote on how he sees it is you now have skin in the game and no longer have soul in the game. And I think that's an interesting like orientation to just that I'm having to get used to, right? When you're the founder that, has large part got all the responsibility, all the control, you got to do all the board stuff, you're owning the future of the company, you have a lot of like a lot of soul in the game, and your whole character and soul is attached to the company in some sense. And I'm now only have my skin in the game, right? I still have an employment role, all of those things that are important, and I believe in what we're doing at the company. But there's a perspective change there that I think happens, which is interesting.
Now, before we continue, a quick word about an incredible resource for startup founders. This episode of the Ignite podcast is brought to you by Build, spelled BYLDD. So what is Build? Well, they specialize with early stage startups, especially non-technical founders and teams, helping you build and launch scalable revenue generating software fast and affordably. Most startups can't afford to drop 100K on some big design engineering agency. Freelancers are risky, inconsistent, and full of project management headaches. For 10K in about a month, they can turn your validated idea into a real market-ready product. It's built for scalability. Past clients have been accepted into YC, Y Combinator, very impressive, received backing from Google, and raised multi-million-dollar rounds. And there's an exclusive offer for Ignite listeners. Get a free UI UX design sprint that's 3 to 4 weeks, a deep dive into your product experience, delivered completely free. This is normally a $10,000 plus service. So head to byldd.com, connect with the Ayush and team, mention the Ignite podcast. Let's get back to it. Yeah, no, it's a little different. I'm sure they give you a big earn out, and like you stay for. I was at a startup that got acquired, and I was leading the demand gen team, and they gave me an earn out, and there's like some golden handcuffs. They have mechanisms in place to kind of keep you there.
Totally, yeah. I have great reasons to stay around and continue building Humbly and making sure it thrives into the future. And it's not just, I didn't just join the Docupace team for any type of compensation. I actually deeply believe in the combined vision there. And that was a big part of the motivator, is that I like where the company is going and what their vision is and how Humbly actually fits into it from a technology standpoint. I'm like very excited about those. And then there's obviously, good reason for me to stick around as well.
Yeah, love that. So in hindsight, as you look back leading up to the acquisition, kind of everything you did as a founder, any lessons distilled from that you can share with founders?
Yeah, I think I wish we bootstrapped Humbly longer. I wish we raised less money. And I think I wish we planned for the consolidation in the industry even sooner. And I think it would have resulted in a better outcome for everyone involved. Not that it was a bad outcome at all, but I think, if I had to nitpick areas where it was my first
bootstrap
time.
A little longer, get a little bit more product market fit, raise from a position of strength a little bit. So you bootstrap. So how, if you can say, like, how much did you raise over the years? And
yeah, so we raised, what did it work out to be? Around $3 million ish, around
total?
that range.
Yeah.
Total. And I don't think we needed to raise all of that to get to the position that we were in the market. I think I would have raised probably a little bit slower and less. Like, I was good at fundraising, Brian. Like, I'm good
I can tell.
sales individual, and I think we took the money just because it was there versus needing the money. And I think that was part of the, not problem, but it was just not, more money doesn't necessarily give you less problems, and you sometimes solve the problems inefficiently when you have more money. And I think we fell into that trap that a lot of founders fall into.
So let's look back at each round and how much would you have raised? Let's give milestones so founders can kind of orient, like, okay, I'm pre-product, pre-idea. Like, you kind of take whatever you can get, like maybe $250,000 from friends and family at like a 2.5 cap, 3 cap, whatever. So you get going. Well, let's talk about the pre-seed. Were you guys at pre-seed? How much revenue did you have? How much did you end up raising? And in hindsight, would you have raised more or less?
Yeah, so we did the classic $250,000 of like friends and family. I think that's actually a good place to start. And I think that was the right, I think I would have probably not, I would have done it with a higher valuation, if I'm being honest.
Your friends and family would have done a 5 cap or even probably a 7.5 cap. Yeah, I don't care. Yeah, they're friends and family.
And it's so funny. Like, I remember still, like, we were so worried about the valuation that we were giving our friends and family. because we're like, oh, is it justifiable? And it's like, I think it's so important to remember that your friends and family are not giving you money because they are trying to make a return off it. They're giving their money purely because they believe in you and they want to support you.
Yeah, you could probably just give them a bunch of uncapped MFN. That's probably the hindsight. Hey, you'll get the best valuation in the next round. Okay, cool. That sounds great.
That's what I would have done. And then we went to the Techstars program as, like, I would call that your pre-seed. And we raised a little bit more money when we got the convertible note from Techstars. It wasn't a lot. I can't even remember exactly, but it was let's say another couple $100,000. And so I'd say, at the pre-seed stage, we probably raised about cumulatively $500,000. And I think that was fine. I would have
That's the right amount at that juncture.
That felt right, and I'm proud of that round, and I think it was the right amount of money to raise. I would have probably increased the valuation or uncapped it or something. And then our seed round is we raised $1.2 million from OCA Ventures and Mucker Capital, and I think that was also, once again, the right amount of money to raise at the seed round.
1.2 at the seed.
1.2 at the seed. Okay. And, we had a good partnership with Mucker and OCA.
Yeah. Those Mucker guys, I on a lot of cap tables with those guys. Yeah.
Yeah, they're great. And they were, founder friendly and all the good things that you want. And they knew the market well and etc. We started growing really quickly, like post seed. And then
How quick is quick? So like founders, like if you're growing quick, what does that mean?
If I remember correctly.
And you could just talk in generalities. You don't have to give specific ARR numbers or anything like that.
Yeah. I think we did like 50 or 60% year over year growth on our ARR. Like it was a good,
solid growth. Okay.
Solid growth. It wasn't like exponential growth or like some of the stories you see, but like for the niche market we're in, like this was good, right? Like it was like a strong indication of continued product market fit. And then, basically it was about 8 months after our seed round. We then took an additional 1.2 million from OCA and Mucker because they wanted to double down. And I think we should probably have not taken that money and continued.
Because at that point, you still have most of the million that you just raised, right? You're burning what? 40, 50K a month at that point, probably?
Yeah, we still had a lot of the money in the bank, but they were like, let's grow even faster. And I think there's an issue with like, let's grow even faster when you're doing, in a niche market, when you're already doing 50, 60% year over year, like, do you really need to grow that much faster? And I think we tried to grow.
Well, VCs like to see at that stage when you're at about, let's call it 500K of revenue, world-class growth would be 4 or 5x year over year.
Yeah.
So like you raised the 250, you got to 250, you raised the 500, you got to 500 to $1 million, and then you raise another $1 million, and now you're at like 3 or 4. And then that's like, okay, like now you're in like Series A territory. That's how we think about it.
Yeah, I would have actually slowed down growth. And I only say that because of the market that we're in. We actually have the wealth tech market is not a huge market, right?
Yeah, but let's characterize that. So it's a TAM of, whatever per year, per head. Like if you went sold to every single person, like how big is it?
So if you just look at the wealth management market from a user standpoint in the US, it's about 1.1 million potential users. Now, globally, it's a lot more than that. But if you look at the market that we're still focused in today, which is, that 1.1 million times, an average of $100 a user as we charge.
About $1,000 a year. So it's $1 billion market in the US TAM. And then the US tends to be like 1/4 to what, like 1/2 of the market?
Yeah, exactly. It's about 1/10 is like the classic back of the napkin math of like, so $10 billion market, globally was some complicated integration requirements for us to really expand the TAM. Like we needed the CRM integrations to expand the TAM, which was like part of our flywheel. It's not a gigantic market. And I think if you just look at, we were focused on the SMB segment, which was about 40, 50% of the cumulative market, right? Like just in the US alone, you were looking at a $400-500 million market, right? A great niche market opportunity, but it wasn't a unicorn like.
Yeah, you're not going to blow through $100 million of ARR anytime soon.
No, you're going
to be grinding it out for 10, 15 years.
Exactly. And yeah. I think I wish I had more perspective at the time on that understanding, because if I knew that, I would have not taken the money and actually just gone a little bit slow over a longer period of time, because we didn't need to hit that incredibly aggressive growth curve that if you're trying to get to the $100 million in AR really quickly, that you would need that money. And so I think that just from as a founder, like making sure that you are realistic and know your market well. I think we probably had ambitious dreams that were probably unrealistic at the time for actually what was true. And if I could go back and be honest with Louis, I'd be like, hey, like this is not an incredibly huge market. Like be realistic about this, rather go slower and take on less money. It's going to result in a better outcome for everyone. I think that would have probably been the right.
Love that. Really good lessons for founders. Thanks for that. And thanks for being so transparent and vulnerable. I think it's hard to talk about all this stuff and what you learned. And any other lessons that you'd love to tell founders out there?
Yeah, the last one I'll share, which I think is a funny one, but it's large part true, is I speak to a lot of younger founders and they're like, oh, I want to start this company and it's, I'm going to accomplish all of this in the next 2 to 3 years. And it's like, well, on average, if you look at the data, it takes on average between 7 to 10 years for any type of liquidity event. Like that's
Right.
just standard.
Yeah.
And so
And that's from like founding the company from seed stage for B2B software companies. It's actually 9 years on X.
yeah,
And
like
by seed stage, you're a year or two into it.
exactly, right? So it's
Really,
actually
it's 10,
probably
it's 10 plus years.
north of 10 years before a good liquidity event for you, which is likely the motivation for most entrepreneurs. And when I say liquidity event, that's normally just recognition that you've built something valuable, right? Like,
Yeah.
And so
You're not just doing it for money, but like just know that it's going to take a while.
it's going to take a lot longer than you think. Hubbly was acquired at basically year 7, which is
Wow.
which is quite funny. But I think the more important question that I try to like dig even a level deeper down than that, it's like, are you willing to dedicate the next 7 to 10 years of your life towards solving this problem for this customer? And do you care enough about that problem and that customer? Large part what you're committing to beyond, any type of, because the liquidity event and all of the other motivations become mute compared to the day-to-day of like solving this problem for this customer for the next 7 to 10
Did you care enough about this to work on it for a decade of your life? And you're only going to work for 40 years, roughly, maybe 50 if you really love working. So this is going to be a big chunk of your life. Are you in that love with the problem and the customer?
Or it's going to fail, period. I think that's a fascinating question to ask yourself. I remember early on, I made a commitment. I was like, I'm going to spend the next 7 to 10 years of my life solving this problem for financial advisors and back office users. And I was like, I made that commitment. I remember saying it out loud. And it ended up working, exactly about that timeline. So.
And what do you think is the biggest misconception about building a startup? Is it that like they just don't understand the time horizon?
I think that's one part of it. The second piece is like the company building stuff is actually quite easy. Like the fundraising, the product building, the go-to-market, right? Like they're intellectual problems that anyone can solve.
Yeah, you can chat with ChatGPT. What do I do to acquire customers?
They're not rocket science.
Yeah,
they're fun.
It's just a lot of execution and how fast you can move.
The things that the hard stuff is going to come for you personally. And what I mean by that is, a large part see building a company is it's going to hold up a mirror to your biggest growth challenges as an individual and like where your blockers are personally, where your triggers are. It's like it's similar to being in a relationship with someone, a romantic relationship, right? Like they're the ones that are going to trigger you the most. They're the ones that are going to, highlight all of your, childhood stuff you haven't dealt with, or your issues with your parents, or, your insecurities. Like they're the ones that are going to highlight that. Company is going to do that on a rocket ship, because it's going to even be more of that faster.
That's amazing. I love that analogy. It's holding up a powerful mirror or a telescope back at your own psyche. And I'm thinking about how running Team Ignite affects me personally, right? And some of the things I'm learning about myself 5 to 7 years into this journey of building this venture firm. And it's not as hard as being a founder by any means, but you definitely learn a lot about yourself. How did you handle that? Like the mental and emotional challenges?
Yeah. Mike Katchen, he's the CEO of Wealthsimple. He shared a quote with me once when I was asking for some advice. He's like, your company will only grow as quick as you grow, which I think describes exactly what you're describing even with Ignite, right? Is that there's like this this pull and tug with like the company's, growth and building it with your own personal stuff. And I think I've generally not been afraid of the personal stuff. I've actually leaned into it every time and then seen it as an opportunity. And I've spent enough money on therapy, coaches, mentors to like help me through those personal
And if you're
growth.
wondering out there if you need a therapist, you do. Just go do it. Trust
The
me.
answer is yes. And
Just go
like
do it.
charge it to the company because
Yeah.
it is as important as paying for
Especially if you're a founder, like you were a solo founder?
I had a co-founder.
Okay. But even in co-founders, like I'm a solo GP, and yeah, you need people to talk to.
Totally. And you need good people and, friends around you and hopefully, good relationships where you can like talk about those things because it, I just put money into those things from the early day and I was not afraid to do that. And I'm very glad that I did. I don't think I would have struggled a lot more if I didn't have those people around me.
That's amazing. What's one decision you made that had a huge impact that was unexpected?
Yeah. So this one was a challenging one. Actually, in November 2023, about just shy of 18 months before we exited, I laid off 60% of our staff at the time.
Wow.
And this was part of the story that I was telling you around we raised too much capital, and what we did in return with that is we hired too many staff. We actually scaled up to a team of 24, 25 at the peak, and we were burning so much cash that we either had to raise more money again, and this was in, November 23 when the fundraising market was
just frozen,
completely frozen.
Yeah.
And I was,
how much runway did you have when you're like, I got to do something?
We had about 6 months of runway. We could have gone through a fundraising process. It would have hurt, where the market was at then, and we would have taken a huge hit. And I was questioning, do we really need to raise more money again now, like in this environment? And in collaboration with our board and our team, we ended up making the harder decision is we pretty much immediately laid off a bunch of staff and we decided, hey, can we, instead of trying to get to a fundraise, can we get the company cash flow positive in the same amount of time? And we large part did the latter, which opened up opportunities for more fundraising, or at large part made a acquisition possible because we were now a cash flow positive.
Yeah, it puts you in a position of strength when you go out to fundraise.
Yeah, and then we had options on the table basically a year later around, do we just keep bootstrapping? Do we now fundraise when the environment was a lot better? And that was the same time we got approached by Docupace. But the process of doing such a, heavy cut to the organization was very challenging.
Yeah, that's a lot. Yeah, because you're laying off friends, lunch buddies, like it kind of rips the culture. Were you guys remote first at that point?
Pretty remote. Most of our folks were up in Canada. We had a good chunk of folks in Vancouver. And, that was definitely a difficult decision. One of the folks that were part of that was my co-founder, Ron, also stepped away from the organization at that point in time. It was mutual and it was the right thing for the organization at the time and for him personally as well. But there was a lot of change very quickly that needed to happen.
Wow. Yeah. So looking back at it all, like if you could go back and send a message in a bottle and a time machine back to a younger version of you, like what would you tell that younger person before starting Hubly, I guess?
Yeah, I'd probably tell him two things. One is trust your instincts even more, and you're generally right, but owning that you're right is the harder thing to be and to do. And so I would trust my instincts more, and I'd probably be not so nice to everyone.
Why not be nice to people?
I think there's I say that part joke.
And I say this I laugh because as a VC, I have to say no to like 99.5% of people I meet.
Yeah.
And I have to be nice about it, and it's tough. It's tough. Because sometimes like the baby is clearly ugly and your deck sucks and your traction sucks and your team sucks. And I can't say that.
You should say that, right? Like,
I do. I am nice enough sometimes to like say, hey, like your deck needs a lot of work. And like, here's my article on that on my Substack.
I think as a founder, the hardest thing to do is like focus in the early days, right? And so if you say yes to every networking event, or you say yes to every phone call, if you say yes to every project and you're nice to people trying to save their feelings, or you end up just hurting yourself. And like, you're large part one of the most important resources in the early days success of an organization. And so, protecting your own sanity and your own energy is so important to the success of your organization. And so I think, when I say don't be so nice to everyone, it's just like focus really on what matters, because there's very few things that matter in the early days of building a company, and it's not that networking.
Yeah, I love that. But come to ours, Club Ignite in November. Ours is going to be important. You're going to meet somebody amazing there. Talk about the future of Hubly and WealthTech, FinTech generally. Like, kind of, let's start with Hubly, obviously, and then kind of go broader. But what do you see over the next 5 to 10 years?
What does the future look like when it comes to financial advice? I think the interesting opportunity that has not yet been tackled to its full degree yet is there's always a lot of focus on the financial advisor. I mentioned earlier, there's about 300,000 financial advisors. It's, better risk assessment tooling for advisors, better tools for, account rebalancing or for managing assets, et cetera, et cetera. Now there's 300,000 financial advisors, but there's about 800,000 back office staff, just if you look at in the US alone. And so just the market size from a user standpoint is about X for the back office staff. These are generally folks in administrative roles doing back office processing, audit, compliance. That part of the market, I think, is still very undersolved as a problem. And it's something that we're just spending more and more time on at Hubly is, even our messaging and that we're talking about is like, we rarely mention the financial advisor. We're like, Hubly is for the back office heroes that do not get the attention or the celebration that the financial advisors do. They do the job that actually services the end client, which is what's the important stuff. And the amount of manual work that still happens and paperwork is insane. Fortunately, through Hubly, we get access to a lot of task level data in the millions of workflows that we've helped complete. And so we'll run queries on let's see what are the most number of tasks that are completed and what are things that are people doing. It is still boggles my mind how many manual emails are sent, how many manual meetings are scheduled, how much legitimate paperwork is still filled out. And there's the problem there is still endless if you just think about the wealth management tech space. And I think the problem is similar if you look at other industries like tax and insurance, is that problem is probably similar. And I don't know if because it's such a regulated space, because of why that still exists. But I think back office workflows, automation is still in its early days of being solved. And that's large part why we also combine forces with Docupace, is they've been solving that problem for the last 25 years at a very large enterprise level. And we're looking to bring that enterprise grade automation to the SMB market, where a lot of the work is still done manually.
Yeah, what's an exciting trend, I think, to kind of build on what you're saying is sort of the, AI is replacing direct, repeated menial labor is what you're describing. Kind of literally the back office pushing paper around and filling out forms. AI is just doing that. AI will fill out the form. AI will file the form. AI will mail the form. And it's all this stuff that, maybe you don't need that 3-to-1 ratio of back office support in the future. Maybe it's a 1-to-1 ratio or a 1-to-10. One back office person for every 10 financial advisors in the future.
Yeah. And I think what's fascinating, so there's the manual work, which I think is the obvious win for AI. What I think is fascinating, Brian, that I think a lot about is there's the work that requires human validation. You actually need a human to own the responsibility and sign off on this specific thing. And I think how do you help empower humans to do more of that work versus the latter, right? Or the former, I should say. I think that's the fascinating thing that I think a lot about is move all the stupid work that a robot should do off their plate so that the humans can focus on the things that truly matter, the things that require their validation or approval or regulatory sign off, whatever it means, because I think I'll increase the overall capacity issue.
I love that. Well, let's wrap up with a rapid fire.
Let's do it.
What is a book or podcast besides the Ignite podcast that you recommend to every founder?
First podcast that comes to mind would be I Love How I Built This, just because of the authentic storytelling. It's just about the individual and their journey. The podcast that I've listened probably to the most on the How I Built This is Jay Carpenter's, who's the founder of Burton Snowboards. I'm a big snow sports geek and spend a lot of time on
I got a Burton snowboard as well.
And just an epic story from Jay Carpenter and the things that he went through in his life are just phenomenal. Book I'd probably recommend right now that I've listened to 3 or 4 times back to back is a book called Novacine by James Lovelock. James Lovelock is a fascinating human. He actually wrote this book when he was 99 years old. He's now died a couple years ago. It's basically, he talks about, we've been in the Anthropocene for the last basically 100 years as human, and we're now transitioning into the Nova scene. And James Lovelock has some really fascinating perspectives about the future of AI and energy and like planet Earth. He wrote the Gaia theory as well. And so really would recommend that book to anyone.
Is he like a techno optimist? Is he like a singularitarian kind of guy, or is he more like kind of dystopian, or is he somewhere in between?
I'd say somewhere in between all of those. He has this deep connection to like Earth and how we can protect the Earth in the future, but he's also like a huge techno optimist at the same time. And he bridges that just so beautifully. And so Nova Scene is the book I'd recommend by James.
What's the biggest challenge in selling a startup that people don't talk about?
I think just when you're going around down the road of raising capital, just understand the VC economics of like the type of company you need to build to return the capital. I think I wish I understood VC math a little bit better in the early days.
Right. Yeah. And like they're preferred shares, right? So VCs get paid first, right? Investors get their money out first. And so you should know that, right? And so like that's why, and companies don't tend to exit. PE multiples are 3 to 5x, maybe 7, 8x if you're growing super fast, or 10x even. But you have to be thinking like, okay, like if I raise $1 million and get to $1 million in top line and I exit, I'm lucky to exit for 10, maybe 20 if I'm growing super fast. And if you're growing super fast and you get to 5, but maybe you've raised 5, like what are you exiting for? And so you got to think about, those exits and how much you're going to really end up with. So you got to be really capital efficient. Capital efficiency is very important. Unless you're like scaling like Facebook, growing 100% a week or something, then hey, by all means, then just pour gasoline on the fire and raise as much money as you can. But when you're building a vertical SaaS business, you got to be capital efficient.
You have to be, and unless you do like the the wise approach and get to 100 million ARR in 2 years, like sure, raise whatever you want to raise when you're going down that path, because you're trying to optimize for time, and that's a great reason to raise VC capital. But when you have more time, go slower and really be conscious about the end economics.
Yeah, that's an interesting perspective. What's one wealth tech startup that impresses you right now?
Yeah, so there's two. The first one I'll call out is a company called Sequence. They're based out of Israel, actually. My friend Gilad founded the company. They basically are like a money router for your personal bank accounts. I don't know about you, but like I manage all of my finances. I have like 3 bank accounts. I manage my partner's finances. She has 3 bank accounts. And it's like just simple like money transfers on an automated basis between accounts. It still seems to be a very difficult thing for most banks. And Sequence has built a money router, which is just a great tool product. They're not available in Canada yet, but I love what they're doing. The other wealth tech company that I'm following closely is a company called Domain Money. They're large part replicating what LearnVest, I don't know if you're familiar with LearnVest, did back in the day with Alexa Von Tobel, where they're trying to bring subscription-based financial advice to market. Now they've raised, I think, $50 or $60 million from Goldman Sachs, and Adam Dell is an ex-Goldman Sachs guy. I really like what they're doing and their approach to the market and how they're building tooling for it. I'm still curious if the model is actually going to work. And so those are the two that I'm following closely.
What's the most valuable skill a founder should develop today in today's market?
I would say it comes down to personal self-awareness and psychology. Do your therapy. Like that is large part, I think, the number one skill set. Like the business stuff, once again, is easy. And the type of therapy I would recommend is called IFS. It's a internal family systems as an approach. It's really about knowing all of the parts that drive you. The general concept is, as a human, we're made up of several parts, right? You might think about, commonly mentioned, you have your perfectionist part, you have your angry part, you have your very hyper intelligent part. The general human system, I like to think of it as an operating system, is driven by all of these parts. And getting a really good understanding of your different parts is really important, so you can understand how you're making decisions from different parts or from self.
Yeah, I love that. What's your favorite productivity hack?
I'll show you it. It's a paper to-do list.
Nice.
That I manage daily. When I'm start of my day, I'll write down my urgent important items and I'll cross them out, and then I'll make the same list the next day.
So funny. My to-do list is a black hole of unproductivity. It's like stuff I write down and I maybe get to like in months later. Like it has to be in my inbox for it to get done. But I live by email. So what's the best piece of career advice you've ever received?
I got a call from a mentor of mine. His name's Udi Doan, another entrepreneur. He called me in the middle of COVID. I called him in the middle of, just when COVID hit, and I'm like, oh my God, the world's collapsing. This is the worst thing ever. And he said a couple of words that just have stuck with me. And those words are, chaos can be beautiful. And I think there's just elegance to that, right? Like there's always beauty in the chaos if you just, want to see it, and like, where's the opportunity in this? And so I kind of like when chaos happens, and because there's gold in there.
Yeah, I love that. Well, thanks so much for coming on. What an interesting journey. Thanks for telling your story. We'll link how to get in touch with you in the show notes. And yeah, thanks. It was an awesome conversation.
Awesome. Brian, thank you for having me here today. Pleasure. Thanks everyone for listening.